If you've been paying any attention to the markets lately, you can feel it, right? This crazy mix of excitement and, let's be honest, a whole lot of anxiety about AI. Are we standing at the dawn of a new technological age, or are we just riding a massive hype train that's about to go off the rails? The signals are coming in fast, and they are overwhelming.
Just look at this number, $1.4 trillion. That's with the T. And that's just the estimated long-term spend for OpenAI. I mean, think about it. A few decades ago, a number like that would have defined an entire economy. Now, it's just one data point in this massive AI landscape. A number this big really forces you to ask the big question.
So, which is it? Is this an out-of-control bubble, just pure speculation run amok, or are we watching the messy, chaotic, but incredible birth of a brand new era? The case for a bubble, well, it's pretty strong, and the evidence is kind of hard to look away from.
I mean, just look at the signs. You've got companies raising $1 billion without even having a product. Valuations in the multi-billions for startups that have literally zero revenue. And you're hearing about 9-figure offers being thrown at individual researchers. For anyone who remembers the dot-com era, yeah, this all sounds very familiar.
It's so easy to see all that and just write it off as pure madness, right? Speculative insanity. But what if that's just the surface story? What if, under all that frenzy, there's something deeper, something more functional going on? To really get it, we've got to look past the simple, negative way we usually think about bubbles.
You know the standard line we're all told? Bubbles are just about greed. It's a game where speculators buy something not because it's actually valuable, but because they hope they can unload it on some greater fool for a profit before the music stops. But what if there's a more generous and maybe even a more accurate way to look at all this?
So let's explore this hidden function of a bubble. This other way of looking at it suggests that even when these manias end badly, and they often do for investors, they leave behind something incredibly valuable. They end up acting like these huge, messy wealth transfers that accidentally finance the infrastructure of the future.
Think about it. Back in the 19th century, railroad investors, a lot of them lost their shirts, but their lost money built the national transportation grid we all benefited from. Same thing happened with the utility bubble that literally electrified the entire country. And the dot-com bust? Investors lost a fortune on worthless telecom bonds, but you know what their failed investments left us? All the cheap, abundant fiber optic cable that powers the internet as we know it today. But see, building infrastructure is actually only part of the story.
That leftover infrastructure is a pretty powerful side effect for sure. But there's a deeper, more fundamental mechanism at play here. You could call it the economics of belief. And it's what explains how these massive, society-changing shifts actually manage to get off the ground in the first place. And it all starts with something called a dependent economic ecosystem.
Okay, so what in the world is a dependent economic ecosystem? The best way to think about it is like a giant line of dominoes. Each domino is a different technology, a different company, a different investment. For any of it to work, for the whole line to fall, every single domino has to be in place at the same time. On its own, each piece is basically worthless. Let's make this real with the AI stack.
Just look at this chain of dependency. You need turbines to spin up massive amounts of new power. That power feeds the grids. The grids have to power the giant data centers. The data centers are filled with GPUs. The GPUs are what run the frontier AI models. And only then do the models enable the applications that we can actually use. You see? If any one of these layers doesn't get built out, the whole tower just collapses.
And this creates a huge chicken and egg problem, a massive coordination problem, right? Why would a power company build a new plant if they're not totally sure the data centers are coming? Why would NVIDIA sink billions into making more GPUs if they're not certain the AI labs are going to buy them? Nobody wants to be the one to jump first and spend all that money alone. So you need something powerful, a shared collective belief that everyone else is going to jump to. And that, right there, that shared belief is what blows up the prices.
In an ecosystem like this, high prices are doing more than just measuring value. They are sending a message, a really loud, really clear message to every single person in that stack, from the people making turbines to the coders writing apps, that this future is real, demand is coming, and it is time to build. The high prices themselves are the coordinating signal. And this isn't the first time we've seen this pattern.
I mean, the entire automotive era was built on this same kind of codependent faith. Ford was building cars assuming someone somewhere was going to build gas stations. At the same time, oil companies were drilling for oil, assuming people were going to buy all those cars. Or electrification. Utilities were wiring up empty houses before most appliances even existed, while companies like GE were designing those appliances, assuming the wiring would get there. It's not neat,
It's not linear, but it works. Okay, so if we accept that we're in a bubble, even a productive one, the one question on everybody's mind is, when does this thing pop? Is now the time to head for the exits? Well, the answer is, surprisingly, not what you'd think.
So all those signals we started with, the crazy valuations, the insane funding rounds, they don't actually mean the party's over. History shows they often mean the party is just getting started. Let's just look at a couple of famous examples.
Back in June of 2001, there was this famous essay warning that the housing market was totally unsustainable and it was all going to collapse. That warning came a full 7 years before the 2008 crisis actually hit. Or go back further. The Netscape IPO in 1995, it was widely called nutty, a clear sign of a bubble that was about to burst. But the actual peak of the dot-com bubble was still 5 years away. So what happened if you listened to those super early warnings?
Well, the numbers tell the story. If you sold your house in 2001 because of that warning, you missed out on years of massive gains. And even at the absolute bottom of the crash, prices were still higher than they were in 2001. And if you sold your tech stocks after that nutty Netscape IPO, you missed the biggest part of the boom. Even at the rock-bottom post-bust low in 2002, the Nasdaq was still up 40% from 1995. It really all comes down to that famous saying, doesn't it? It's not that people are just ignoring the facts. It's that these huge booms are driven by collective belief. The belief creates the reality, and then the reality reinforces the belief. A boom keeps going as long as enough people believe it will. That's not irrationality. It's just how these huge macro systems actually work.
So where does all this leave us? Well, instead of just asking if AI is a bubble, or even when it's going to pop, maybe we should be asking a totally different and, frankly, a much more important question. First, let's just get the facts on the table and acknowledge them. Yes, AI is in a bubble. Yes, a lot of these companies with sky-high valuations are going to fail. And yes, the amount of money being spent right now is, by any sane measure, completely unsustainable. But none of that is actually the main point.
The real question, the one that really matters in the long run, is this. Are the trillions of dollars pouring into data centers and GPUs and AI models right now building an infrastructure that's going to unlock a whole new technological era? An era that will still be here long, long after the speculative fever has broken?
And if we look to history for the answer, the evidence is pretty clear. The answer is probably yes. From railroads to electrification to the internet, this messy, wasteful, speculative pattern has played out again and again. And it keeps repeating for one simple reason. For all of its flaws, it works.
So maybe the focus on the bubble itself is a bit of a distraction. Maybe the biggest risk isn't getting caught when it pops. Perhaps the bubble is not the danger. Missing the moment is.